In this short video, we're going to take a look at a relatively new covered call ETF, SPYI. People really like it because it has a very high dividend. It's becoming quite popular, and it also is quite tax efficient, which we'll take a look at towards the end. Now, we'll compare it to SPY, which is just a ETF for the SP 500, and we could have used other ETFs, for example, SPYM, which is only $80 a share, by the way, currently. But we'll compare it to SPY. Now, these figures are as of April 9th of 2026. The inception date of SPYI was August 29th of 2022, so it really has not been around very long. SPY, of course, goes all the way back to 1993. The price per share is $51 compared to SPY, which is $681 a share. But again, if you want an ETF that's lower in price per share, you can just check out SPYM, which is only $80. The expense ratio is 0.68%. SPY is 0.09%. This one is only 0.02%. Now, the 1 year total return, this is going back from April 9th, back 1 year from that date. So the total return includes the dividend plus the share appreciation. You can see the dividend yield for SPYI is 12.5% as opposed to only 1.14% for the SP 500. But the total return, okay, going back 12 months from April 9th, is 23.54%. And for SPY, it was 25.35%. Now, if we go back 3 years from April 9th, the 3-year total annualized return, which includes the dividend plus the share appreciation, is 15.49% for SPYI and 19.97% for SPY. So you can see it trails by about 4.5% annually for the total return. But people like this dividend of 12.5% annually, and that dividend is paid out as a distribution monthly. Now, if we do look at the calendar years, 2022 kind of is irrelevant because it only included a few months. But in 2023, SPYI trailed the SP 500 by about 8%. In 2024, it trailed almost 6%. And last year in 2025, it trailed about 1%. So the 3-year annualized return going back again from April 9th is about 4.5% greater. So we're getting this nice income, monthly income that we can count on, but we are giving up some total return for that luxury. Now, they hold all the same stocks. Here's the SP 500. Here's SPYI. The percentages are basically the same. All the stocks are the same. NVIDIA, Apple, Microsoft, Amazon, and so forth. So it's linked to the SP 500. Now, let's take a look at the performance since its inception date. Okay, so going back to August of 2022, all the way up through April 9th of this year, the dark green line is SPYI. And you can see over that total period of time, its total return is 60.5%. However, SPY, its total return is 79.66%. So again, you're getting that guaranteed monthly income, but you're giving up long-term gains. That's the trade-off a little bit. Now, again, to see what a difference that makes, if I just take that annualized return that we talked about, that's about 4.5% more for SPY. And if I look at $10,000 invested over 3 years in SPYI, again, the total return, dividends plus share appreciation, would have grown into about $15,403. SPY, $17,267. Okay, so that's about 18.6% less in total gains just over those 3 years. Now, let's take a look at the efficiency of the tax situation for this. Now, of course, when we're talking about taxes, this is only relevant if this is held outside of a tax advantage account like IRAs or 401ks, whether they be traditional or Roth. Now, if they're in a retirement account sometime, then it's irrelevant. But approximately 93 to 97%, depending on the year, of the distribution is classified as return of capital. Now, because of the strategies that they use with tax loss harvesting and their option strategy, it does not erode the NAV, at least not to this point it hasn't, okay, but it is classified as return of capital. The remaining portion is subject to a 60-40 split, where 60% would be long-term capital gains, 40% would be short-term capital gains. But that's a little irrelevant because, for example, in 2025, only about 5% of the total distribution was subject to this type of 60-40 split. Almost all of it was classified as return of capital. Now, what that does then is it reduces your cost basis. Okay, in fact, if we take a look at that, it's that distribution that you're receiving isn't even taxable in the year you receive it. So it has a more favorable tax treatment than interest, for example, like on bond interest, high yield savings accounts, CDs. Interest like that is taxed as ordinary income, so at your marginal rate, rather than the more favorable capital gains, long-term capital gains. Okay. Return of capital distribution is not taxable in the years received. The return of capital reduces your original cost basis. Okay, so later on, when you sell the shares, that's when you would pay the long-term capital gains. The cost basis, if you hold this long enough, can hit zero. Now, after which any distribution that you might receive would then be taxed in the year you receive it as long-term capital gains. So basically, it defers the taxes that you owe for the capital gains. It pushes your tax bill into future years. So basically, you get to hang on to your own money and use it as you see fit longer before you give it to the government. Okay, your tax liability would happen when you sell the shares. Now, this could be an estate planning tool then, possibly, because if you never sell the shares and then if somebody else inherits them after you pass, okay, your heirs get a stepped up in basis. Now, the fund can go down in value. You need to remember that. It's still tied to the SP 500. So the share price can drop just like the SP 500 can. It has a very short track record. Okay, over this period of time, it has underperformed the SP 500. And because it's actively managed, we really don't know how it's going to perform in other environments. For example, if we have a 2 or 3 year market where it kind of goes sideways or slightly negative, okay, we don't know how it's going to perform. But so far it's performed very well. In fact, it's maintained a very steady monthly distribution. Here's the annual distributions. You can see it's remained quite steady. And here's the trailing 12 months. So anyway, these can be very beneficial for people looking for steady income that they can count on. For that benefit, though, they are giving up some longer term total returns. But for people in retirement, sometimes they really like these kinds of funds. So anyway, I hope some of this information has been helpful to you. Please hit the like button. Let me know if you like any of these or maybe some other covered call ETFs. And I will see you next time.